$500 million gone in a single trading day. That is how much money short sellers lost betting against the one healthcare stock we are about to break down for you today. Somewhere out there right now, an entire desk of professional traders is staring at a red screen, wondering how they got this so wrong. Welcome back to Smart Stock Sam, the channel that gave you the exact buy zone before this stock exploded higher. If you are just clicking on this video because the title caught your eye, here is the short version. HIMS stock just hit $35. Is it too late to buy? Stick around, because by the end of this video, you will know exactly where this stock is heading next, and exactly how to play it without getting burned. Today, we are giving you a complete masterclass on HIMS and HERS Health, ticker symbol HIMS. We are going to show you why this stock just went completely parabolic, how the options market is forcing market makers to buy shares whether they want to or not, and where smart money believes the price is heading from here. We will also show you the one risk factor almost nobody on social media is talking about right now. We have a lot of ground to cover, so let's get right into it. Before we look at where this stock is going, let's look at exactly how we got here, because this part should give you serious confidence in everything that follows. In our previous video, published just days ago, we laid out a very specific roadmap for this stock. We told you that old resistance had flipped into brand new support, creating a precise pullback entry zone between $29.50 and $29.80. We told you the primary target was $32, and we told you that if a short squeeze kicked into gear, this stock could rocket into a panic zone of $33 to $35. Then the market did something remarkable. It followed the script almost perfectly. The stock dipped to a low of $29.68, landing right inside our buy zone. The very next day, riding a massive risk-on wave from a peace agreement between the United States and Iran, the stock surged and closed at $31.89, hitting our primary target almost to the penny. But the real fireworks were still to come. The stock then unleashed a violent breakout, surging 11.23% on more than 31.9 million shares traded. It blasted straight through our panic zone, peaking at $35.60 before closing at $35.47. When a forecast plays out with that kind of precision, it tells you something important. This move is not random. So now the only question that matters is this. Could the next leg actually be even bigger than the one you just watched happen? Here is the thing though, technicals alone do not make a stock explode like this. To understand the real violence behind this move, we need to look underneath the hood. What you are watching right now is two perfectly synchronized engines firing at exactly the same time. Engine number one is fundamental de-risking. This company has been making aggressive moves, striking massive acquisitions, and most importantly, putting a major legal threat completely to rest. Engine number two is volatile market mechanics. We are talking about a mountain of trapped short sellers, explosive options gamma, and market makers who are mathematically forced to hedge by buying stock. When you combine a rapidly legitimizing business with forced buying pressure, you get something that looks a lot like exponential momentum. And stay with us, because there is one hidden number buried inside the options data that could completely reshape how you think about this company's valuation. Let's start with engine number one. What exactly did this company do to shatter the bear case so completely? For months, the single biggest risk hanging over HIMS was legal exposure. The company built a fortune selling compounded versions of popular weight loss drugs, and that invited serious patent infringement threats from pharmaceutical giants like Novo Nordisk. Bears were convinced this company could get sued into the ground. Then HIMS pulled off an absolute masterstroke. They struck a direct distribution deal with Novo Nordisk to sell their FDA-approved branded weight loss drugs, Wegovy and Ozempic, right on the HIMS platform. The result? Novo Nordisk dropped its lawsuit completely. In one single move, the company erased its biggest regulatory overhang and earned legitimacy in the eyes of the medical community. Now you might be thinking, what about Amazon? Did you know Amazon just rolled out a $29 telehealth option for GLP-1 drugs? Here is the catch almost nobody is talking about. Amazon's offering is limited mostly to prescription renewals, not new prescriptions. It barely scratches the surface of the all-encompassing subscription model HIMS has already built. And this company is not just defending its turf in the United States, it is aggressively buying its way into global scale. Take a look at this. HIMS just closed a massive $1.15 billion acquisition of the Australian digital health platform Eucalyptus. This is not a vanity purchase. This is a calculated land grab. Overnight, the company absorbed 850,000 active customers. Even bigger than that, it instantly opened doors into Australia, Canada, Germany, Japan, and the United Kingdom. Management is now targeting $6.5 billion in annual revenue by the year 2030. You do not chase numbers like that without a real global footprint, and this deal proves they are willing to spend big to lock down international market share. But if you think international expansion is the biggest catalyst sitting on the horizon, wait until you hear what is happening at the FDA. Mark your calendars for July 23rd and 24th, 2026. This could be the single biggest binary event for this stock all year. The FDA's Pharmacy Compounding Advisory Committee is meeting to decide whether to add peptides to an approved list of bulk substances. With the U.S. Health Secretary actively pushing to loosen restrictions around these compounds, the market is bracing for a green light. Why should you care? Let's do the math together. Analysts estimate that if HIMS captures just 4 to 5% of the combined peptide market, that translates into somewhere between $10 billion and $19 billion in annual revenue opportunity by 2030. That is a jaw-dropping addressable market. The stock is already pricing in a sliver of this anticipation, so here is the real question. What happens to this chart if the FDA actually says yes? Wall Street is watching these same catalysts, and analysts are scrambling to rewrite their models in real time. When the facts change, smart money changes its mind fast. Following the Novo Nordisk deal, Barclays stepped up and raised its price target from $29 all the way to an overweight rating of $39, citing alternative data showing the company's website traffic jumped an incredible 35% year-over-year in May. Needham completely reversed course, upgrading the stock from hold to buy with a $30 target, openly stating that the Novo deal fundamentally strengthens the company's weight loss platform. Even the most stubborn bears are waving the white flag. Citigroup upgraded the stock from sell all the way to neutral, nearly doubling its price target from $13.25 to $24. When institutions are forced to upgrade this aggressively, retail investors need to be paying very close attention. And speaking of institutions, let's look at exactly who is buying behind closed doors, because this part might surprise you. If you want to know whether a rally is real, follow the big money. Right now, HIMS holds a perfect 10 out of 10 institutional confidence score, ranking it number 1 out of 76 companies in the entire healthcare provider space. Institutions currently control 63.52% of the total float, with major players like Bank of America recently adding nearly 3 million shares to their position. And insiders are buying too. Board member David Wells just made a highly bullish open market purchase of 48,400 shares, worth roughly $1.2 million. Now let's address the elephant in the room directly. You may have seen alarming headlines claiming the CEO and CFO were dumping shares. Let's clear that up right now. SEC filings confirm these were entirely routine, pre-planned trades scheduled in advance, or simply shares automatically withheld to cover tax obligations when restricted stock vested. This is standard corporate procedure. It is not bearish dumping, no matter how scary the headline sounds. Now that we have established just how strong the fundamentals are, it is time to pull back the curtain on engine number 2, the violent market mechanics actually driving this price action minute by minute. Remember that $500 million we mentioned at the very start of this video? Here is exactly where that money disappeared. As of late May, there were 62.61 million shares sold short. That represents a massive 30.66% of the entire public float. This was an extremely crowded, extremely dangerous trade for the bears to be sitting in. The days to cover ratio sat between 3.1 and 4 times average volume. When the Novo Nordisk news broke and the stock began ripping higher, those short sellers were instantly trapped with nowhere to hide. In a single day, they absorbed an estimated $546 million in mark-to-market losses. When short sellers start bleeding money like that, their brokers force them to buy back shares just to close the position. That panicked buying pushes the price even higher, which then traps even more short sellers, who are then forced to buy as well. It becomes a self-feeding loop of forced involuntary buying. So ask yourself this: how many of those trapped shorts do you think are still left on the board right now? And while the short sellers are panicking, the options market is throwing absolute gasoline on this fire. This is where the math gets genuinely exciting. On the day of the breakout alone, more than 307,000 options contracts changed hands. Take a look at this volume breakdown. A staggering 79.1% of all that volume was bullish call options. The put-to-call ratio sat at an incredibly bullish 0.36. But the real story is hiding in the open interest. There are now more than 1.13 million total contracts open, with massive concentration sitting right at the $35 and $40 strike prices. Why does that matter so much? Because of something called a gamma squeeze. When traders pile into call options like this, the market makers who sold them those contracts are left holding enormous risk. As the stock price creeps closer to those $35 and $40 strikes, those market makers become mathematically obligated to buy shares of the actual stock, just to hedge their own exposure. So picture this for a second. Short sellers are being forced to buy. Market makers are being forced to buy at the very same moment on the very same stock. So how is all of this forced buying actually showing up on the charts? Could the move you just watched unfold actually be the smaller half of this story? Across every single time frame we track, the technical picture is screaming strong buy. The stock is currently trading securely above its 5, 10, 20, 50, 100, and 200-day moving averages. For context, the 50-day moving average sits all the way down at $30.25, and the 200-day average is positioned even lower at $26.66. From a momentum standpoint, the 14-day RSI is sitting elevated at 74.709. Traditional textbook traders will tell you that number means the stock is overbought and due for a pullback. But inside a genuine momentum squeeze, an overbought RSI often confirms something very different. It confirms real structural strength and real buying pressure underneath the surface. On top of that, the MACD indicator sits at a positive 1.49, firmly confirming the bullish crossover already in motion. Now, none of this matters if we ignore the risks, because as an investor, you can never let yourself get blinded by a screen full of green candles. If you are thinking about holding this stock for the long haul, not just trading the squeeze, there are 3 critical indicators you need to track closely to protect your capital. First, watch subscriber retention versus pricing. HIMS is moving customers onto branded GLP-1 medications priced around $149 a month, and we need to watch churn rates carefully to see whether customers start fleeing toward cheaper, heavily discounted competitors like Ro. Second, keep your eyes locked on that FDA peptide decision in July. This is a true binary event. If it gets approved, it validates that entire $10 billion addressable market story. But if the FDA says no, expect the market to strip those premium valuation multiples right back out of the stock, almost overnight. Third, watch the Eucalyptus integration closely. International expansion sounds fantastic in a headline, but upcoming earnings reports need to prove this $1.15 billion acquisition is actually delivering real accretive profit margins, not just empty top-line user growth with nothing behind it. With all of that data laid out, how do we actually trade this stock starting next week? Let's map out the exact plan, because HIMS completely blasted through the $35 psychological ceiling, this stock has shifted from a standard breakout into a full-blown momentum squeeze. In a moment like this, traditional valuation models temporarily take a back seat to raw market mechanics. Our objective right now is to capitalize on this ongoing short and gamma squeeze, while still using newly formed structural support levels to manage risk responsibly. Do not chase the $35.47 peak out of pure FOMO. The smarter move is patience. We want to wait for a structured intraday pullback into our target entry zone of $33 to $35. Buying inside that pocket gives you a dramatically safer risk-to-reward setup than chasing strength blindly. To execute that plan properly, we need to know exactly where the floor sits and exactly where the ceiling begins. Here is your complete execution grid for navigating the expected volatility over the coming week. If the stock pulls back, primary support sits at $33. That level was a recent swing pivot, a psychological floor, and the base of a prior institutional buying zone. If the market corrects more aggressively, secondary support sits between $31.50 and $32. A break below $30 would completely invalidate the short-term squeeze thesis, so that line matters a lot, and it is the one level every trader watching this stock should have marked on their chart. Now let's look up. Our first resistance target sits at $36.50, a near-term pivot point loaded with options friction. Our second target sits at $38, but our ultimate target for the week sits between $39 and $40. Barclays' new $39 price target is likely to act as a powerful institutional magnet, and $40 is the terminal option ceiling where market makers are most heavily exposed. If $36.50 breaks cleanly, do not be shocked if price accelerates rapidly straight toward that $40 level. The only real question left is whether this happens in days or whether it happens in a single explosive session. So what does all of this actually add up to when we put every piece together? The verdict is clear. HIMS and HERS Health remains a strong buy with real upward runway still ahead of it. The company is fundamentally de-risked following the complete resolution of the Novo Nordisk lawsuit, and its platform has earned genuine legitimacy. It has unlocked serious global scale through the Eucalyptus acquisition, paving an aggressive path toward that $6.5 billion revenue target by 2030. And right now, this stock is being propelled by explosive market mechanics, a relentless wave of price acceleration fueled by trapped short sellers and forced options, hedging working together at the same time. Before we wrap up, a quick and important reminder. This video is for educational and informational purposes only, and nothing in it should be taken as personalized financial advice. Stocks are volatile, the markets can change direction without warning, and you should always do your own research or speak with a licensed financial advisor before making any investment decision. Past performance, including the forecasts we discussed earlier in this video, is never a guarantee of future results. So, here is a question for you to answer in the comments below. If HIMS pulls back into that $33 to $35 zone next week, are you brave enough to buy that dip? Or are you waiting for confirmation above $40 first? Let us know exactly where you stand. If this breakdown helped you understand what is really happening underneath this stock, do us a favor and smash that like button. It genuinely helps this channel grow. If you are new here, hit subscribe and turn on notifications so you never miss a setup like this one again. And if you want to go even deeper, we have officially launched channel membership. Join our exclusive community to get breakdowns before they publishes for crowd and a serious edge as you level up your investing and trading game. If you simply want to support the channel directly, you can also send a super thanks using YouTube's built-in support feature, and we genuinely appreciate every single one of you who does. Let us know in the comments if you are buying, selling, or holding HIMS this week, and we will see you in the next video.